All right, with buy the dip back in full force, it seems. The valuation people must be absolutely livid right now, screaming from the rooftops. But anyway, in terms of overall risk sentiment, guys, things are pretty neutral at the moment, at least after the solid run higher that we saw on Friday, as well as the extension in equities we saw yesterday. It's not a surprise to see things just start a little bit more slower this morning, especially since we also have US jobs data on tap coming up tomorrow. Looking at some of these markets in a bit more detail, let's start with equities then while we're on the topic. Look, it all seems right in the world once more, because the S&P is once again within licking distance of all-time highs. The Nasdaq also making some decent gains. We are currently struggling though, at least for now, to break back above that New Year's pivot. On this chart, at least around the 25,268 level. Definitely areas that you always want to have marked up on your charts, those New Year open prices. So we are currently just struggling to get back above that. If we do manage to break and close back above that, definitely looking for some continuation in upside momentum there. Obviously, jobs data on tap, we need to pay attention to that. But there was some news out on Bloomberg that hedge funds piled into record short selling in US tech last week, which in my honest opinion means that the pain trade is likely further higher here for technology. But apart from the S&P and the Nasdaq, the one chart that we need to talk about, which has been both painful to watch as well as exciting to watch, is the Nikkei. Now, after the surge higher that we had yesterday, we were very patient. We waited for a gap fill, which we eventually got. Now, we don't always, of course, get a gap fill, but we were patient enough to wait for it. We didn't want to get in on the highs. We waited for price to pull back. We waited for a decent level to get back in. And obviously, chose a stop, which in my opinion wasn't too tight. Obviously, price proved me wrong by, a marginal distance. And when I woke up this morning, not only was I out of the trade, obviously, but it just went in absolute steamroller mode, currently moving back up towards all-time highs, which, you cannot explain this type of pain to someone who is not a trader. It's just the amount of frustration when I look at this thing is immense. But anyway, apart from that, the bias, I think, for the Nikkei remains tilted higher after the PM had that massive landslide victory. When you think about the fiscal implications, there is really no reason for markets not to like the Nikkei right now. So despite me getting my ass handed to me yesterday, it's still a market that I'm watching closely for short-term opportunities by trying to take advantage of both, on the one side, the positive fundamental backdrop and this fantastic momentum that we've seen in this market. So definitely one that I'm watching for short-term opportunities after I'm done licking my wounds, basically, from yesterday on that one. Now, over to the FX space in connection with this, the one thing that hasn't really worked according to market expectations or plans has been the Japanese yen. It seems like that is another potential pain trade in the making here, because just like hedge funds piled into technology shorts last week and got run over, it looks like something similar could be happening to them on the FX side as well, because we heard a lot of them were piling into shorts in the run-up for the yen, that is, into shorts in the run-up to the Japanese elections. Now, that trade worked very well last week, to be fair, but yesterday and today's price action has been unexpected for the yen, at least in my view. Now, we mentioned yesterday that, the ultimate pain trade from here would be sudden yen strength, followed by continued Nikkei upside. As the Nikkei runs higher on fiscal expectations, the yen, potentially could find some love if markets, for whatever reason, decide to focus on the medium-term growth prospects, if you will, for Japan. Now, personally, I won't go that far when it comes to the yen, because there's still that beautiful thing called carry, which is still alive and kicking. Unless that completely disappears, it's tough to argue for more upside here for the yen. Now, I wouldn't want to be short or long the yen right now. I think the Nikkei is honestly the simplest way to express optimism about the election results without the risk of being run over by intervention, or stupid comments from the BOJ. Just be, wary about where you place those stops, I reckon. That's the lesson from yesterday, which I will not stop moaning about this for the next 4 weeks, just FYI. So get ready for a lot more rants about this. Also in the FX space, I do think some of the weakness we've seen in dollar yen is obviously dollar driven, right? The dollar has had a pretty tough week so far, pushing lower yesterday on a move that many is blaming on that news that China instructed financial institutions to ease their exposure to treasuries. But I do think there's a lot to play for the dollar in the short term for traders with NFP coming up tomorrow. One thing that is worth noting about the dollar, let's just quickly go to positioning here for a second. It is worth noting that dollar positioning, let's just get that up. Here we go. Dollar positioning as of Friday is currently sitting on hefty short positioning with funds piling into shorts recently. Now, this is not a reason to buy the dollar. It simply means that when we consider NFP tomorrow, an upside surprise will likely have a potential bigger impact compared to a miss. That doesn't mean that we can't see downside on a miss. It just means that if you want to look for short-term moves, a big upside surprise will arguably, with this positioning, cause the most pain and could see a bigger move in the markets, especially after Kevin Hassett yesterday dropped a possible hint that maybe the jobs numbers won't be looking as great this week. So we'll obviously need to just need to pay attention to that, but keep that positioning in mind for tomorrow. The other currency we need to talk about, which has so far, in my opinion, defied gravity, is the pound. I mean, after the political issues that surfaced, and then on top of that, the very dovish, in my opinion, Bank of England we saw last week, I'm still expecting the pound to soften. My pound dollar trade got run over with the dollar weakness, which is fantastic as well. But looking for moves higher in things like the pound Kiwi, and then looking for opportunities to get back in on the short train. That's definitely what I'm focusing on right now. I think there is more bearish momentum to be had for this one. The momentum, if we look at from a policy point of view, there's a very clear central bank policy divergence between these two central banks right now. The chart from a momentum point of view, still very, very bearish right now. If you consider even things like retail positioning, the retail crowd, they've been adding a ton of longs on this. That's exactly what you want to be. From a contrarian point of view, you want to see this type of long exposure for retail and basically lean against that. Furthermore, if we go back to institutional positioning here for a second, we spoke about this yesterday as well, but institutions, despite the very optimistic view of the RBNZ this year, the market from an institutional point of view is still they are yet to trim that big short position that they have in the Kiwi. So I do think there's a lot more runway to the upside for the Kiwi. What we really need now in the short term is just a few very solid economic data points for New Zealand, I think, to really get that train going. So it's definitely one that I am watching here in the short term. Apart from that, let's quickly take a look at commodities. I mean, silver, the biggest, it's gone from the biggest gain yesterday up over 6% to today being the biggest loser so far, down to 2%. When something can move with that much force without anyone really paying attention to it, it speaks volumes of the type of higher vol regime we've had to get used to in terms of these assets. When you look at things like implied volatility right now, my gosh, still crazy high. For gold, we still, even with the move lower, we're still trading at a 29%. For silver, still sitting at 80%. With numbers like this, the odd 6 or 10% move just isn't a surprise in something like silver, which is either scary or very exciting, depending on how leveraged you are and on which side of the market you are, of course. Just keep in mind, these things are incredibly spicy right now. So, not a bad idea to adjust risk accordingly. In terms of oil, also a little bit calmer today after the upside we saw yesterday. More geopolitical risk premium, obviously yesterday with the US advising vessels that is going through the Strait of Hormuz to basically try and steer as far away as possible from Iranian waters. That obviously saw a bit of upside yesterday. So far today, not looking too bad on the momentum side either. Other markets to be aware of, I mean, crypto, geez, what an ugly chart this remains. Look, ETF flows last week showed a little bit of inflows coming in, most likely as those longer term investors, like the idea of buying something that they like at half price. Who can blame them? But if you are a trader in this market and not an investor, I think following momentum and flow is the simplest way of trading this right now. It's too spicy for me, but if I had to trade it, I would not want to get married to any particular direction here. Don't get me wrong, momentum is very ugly and it's very bearish. But I think you need to allow price action to show you where it wants to go, and that means following the momentum. It means that if we were to break back above these key levels as we make our way potentially make our way back to the upside. Don't fight those types of flows. Remember, this type of volatility, it works both ways, both up as well as down. In terms of the day ahead, obviously things we need to watch for is ongoing developments in the UK political mess. We've got further Middle East developments we need to watch. Obviously, watching charts like the Nikkei, very important for me right now. On the data side, we do have US retail sales data on tap, which could be a bit more interesting after the recent confidence data that we had. But as always, remember that you get silver volatility, which is crazy, and then somewhere above that you get US retail sales data volatility, right? This thing is so volatile. It's honestly an economic data point that I hate. It's always take the number with a pinch of salt, and remember to always watch those revisions closely, right? Big headline misses or beats can easily be discounted if the revision shows something different. That's why the best case scenario for movement is if we see all of these measures coming in either very hot above market's maximum expectations with upside revisions, or if we see a massive miss across the board with downward revisions. You basically want to have the type of outcome that gives the markets as little amount of ambiguity about whether it was good or bad. That's basically what you're looking for. I doubt whether we get that today, but again, with confidence data, last week, it is something worth keeping on the radar as always. So with that said, hope you guys have a fantastic session. As always, any questions, don't hesitate to let me know.